Hey, it's Soleil, and this is episode 439 of the Orange Pill Investor. And today I want to talk about critical mass. I've discussed it a few times, but I think I need to circle back to some of the original content that I put out. And it just occurred to me, I forgot to do a sound check today, test recording. So if my audio is jacked up, let me know, and I'll unplug the mic and plug it back in. So if I sound like I'm streaming from the closet, let me know. But it reminded me that with some of my covered calls being underwater, it's a good reminder to a certain extent that it no longer matters. And depending on your account size, it may matter. Thanks, Hash. Thanks, Howard. For somebody who's got just 100 shares of a stock and they're like, I cannot risk letting them get called away, completely understand that that terror, especially if you've scrimped and scraped and saved up 100 and you finally got to like 100 shares of strategy. It's like, okay, do I really want to put that at risk? Maybe not until we get some kind of face melting rally that makes it a little bit safer, right? Like if you had done it after November, after a 4x move, that would have at least made it somewhat safer. Plus IV was spiked last March, not 2025, 2024. After that 4x move and a nice spike in IV, that would have made that safer. There's no such thing as a safe strike. People always want to know what's a safe strike, and even the Hermes specials, the 10 deltas, they're safe-ish. Like that's in air quotes. It's a lot easier to roll those for a credit. However, like there's no guarantees in the stock market, and even if I went out and got the 10 deltas, I don't know, 10 deltas is probably like 550, somewhere between 550 and 700 or $600 right now, a month out maybe. There's no reason why strategy couldn't be 1,000 in a week. And so it's also a good reminder that the definition of a call, buying a call, it gives the buyer the right but not the obligation to buy the shares at that strike. And if you're a seller, you have to understand that the buyer is in control. You have sold your rights, really. You have sold control of those 100 shares to another person. It doesn't say the buyer has the right but not the obligation to buy the shares at that strike unless the seller has chosen the perfect strike that will never get exercised and they'll just get free money forever, right? That's not the definition of a call, of buying a call. The buyer has the control. Now, the market may not cooperate with the buyer, and it may not ever go in the money and provide them an opportunity to exercise that call. But you do have to at least go into that understanding that the risk is real, and to a certain extent, the risk is inevitable. I used to follow Tasty Trades research just like religiously, and I kind of had my hopes of getting on one of their segments called All Stars, where people who implement their basically trading philosophy, and then they make a bunch of money, and then they get featured on the show. And there was this lady who was like famous. She was making a ton of money, and I think she was even managing. I think she started managing in a fund or something. And she was selling these really wide iron condors, and they were printing very small amounts of money, but aggregated over weeks and months and years, she was just gathering, tons and tons of profits. But at one point, even she was selling like out beyond 2 standard deviations, and the law of averages just catches up with you. And she got into a situation where she just kept trying to roll out those damn iron condors and roll them out and roll them out and roll them out. And this was after she got featured on the show, I believe. She ended up getting wrecked. And I think she blew up that fund. And it was a little bit of a controversy because she had been featured on that show. So it was kind of like they were giving her a tacit endorsement of like, hey, these strategies are foolproof or whatever. And that's not the case, especially with something like an iron condor or a credit spread where it's a defined risk trade. So you can't lose more than you have, but you can lose 100% of it. So that's kind of an important distinction with credit spreads. It's a win or lose type of bet. So I like them for their capital efficiency, but it's not something that I would just do with 100% of my account, or even probably more than 10% of my account. Because if the market goes against you, you do end up losing 100% of your collateral. Whereas with a covered call strategy or cash secured put strategy, you at least have the value of the stock after it crashes. So unless you just you pick a complete dog that goes bankrupt, you're still in the game, right? Even if strategy crashes to 225 again, like I was still in the game back here in April, right? Strategy bounced off of 225, 230, 240. So even though my account had crashed 50 to 60% from November, I wasn't out of the game because all of my share positions still had value and they have no expiration date. So all of those long calls that expired in June and July, those were all, giant losers because the market did not cooperate with my expiration date. But all of my shares have been, just trucking along. There's no timer ticking on them. I can just continue to implement the strategy forever. So that's a good thing to get out of the way, is that there's no safe delta. There's no absolutely safe delta. The lower ones, the 10 deltas are easier to manage than 20s. The 20s are easier to manage than the 30s. But you're also going to collect more or less money based on the delta that you select. So that was a whole ass lot of things to say just to get around to what I mean by critical mass. And with something as expensive as MicroStrategy, it's a little bit harder to achieve critical mass. But the way that I define it is, once your account reaches a certain size whereby you can sell enough covered calls to generate enough premium that every time you do it, you've got enough premium to buy another 100 shares, which entitles you to sell another covered call. So, if I have 100 shares of strategy, it's going to cost me $44,500. I sell a covered call. This is pre-critical mass stage, right? I could be super aggressive with it. No upside. I could just collect. And it's Tuesday, so we, on selling these on Friday would be, you'd get a little bit extra off of these. But you can basically sell almost 2% return on capital at the money. No upside, right? You can get 1% at the 460, so just a little bit of upside, maybe like 3% call away value here. This, $500, $600, $700, $800 is not enough to buy another 100 shares of strategy. So if you're capturing 2% return on capital, you would need 5,000 shares in order to reach critical mass on strategy. Because owning just 100 shares means that you can get 2% a week, But that 2% a week over 52 weeks adds up to, 100, 104%, which is a spectacular return by any stretch of the fiat imagination. However, that is just a linear return, right? It's pretty easy to figure out. However, once you get enough, your portfolio reaches a certain size, and mine hasn't quite gotten there yet with respect to strategy, but we'll see later that you can do this with any stock. It doesn't really matter. And you can mix and match, right? You can have the main portfolio in strategy, and then you can try to work the critical mass with some cheaper stocks. So we'll see. I'll go over how that works later. But once you get enough shares to where you're able to buy an additional 100 shares, the returns go from linear to exponential, and it turns into a compound interest strategy. My dad was a cheap and dirty carpenter his whole life, and he tried to teach me a little bit about money when I was younger so that someday I might not be broke working paycheck to paycheck. And he tried to teach me about the power of compound interest. And so the way that it works is like, I think back in the day you could get 5% interest on certain, that was probably when interest rates were high, but let's just say it's 3%. You raise that exponent to the number of times this is going to get compounded. So if it's 3% a year and you're going to stockpile your savings for 20 years, you would end up with 1.8x your portfolio. So if you started with 10 grand, you'd end up with 18 grand after, what did I say, 20 years? If you started with 100 grand, you'd end up with 180 grand. Those aren't the type of returns that we're trying to get, but that's still better than if you started out with $1,000, 3% would be $30, right? If you just added $30 to that account times, a month times 12 months times 20 years, that would take quite a while for that to add up, right? That's just adding linearly. So with strategy, it's going to take a metric ass ton of shares to get to that level. Now, the good news, though, is that when IV is high, you might be able to get 3%. But how can we get, and maybe I'll take a look at this little Excel spreadsheet that I put together first. So if you're able to get 1%, and you've got one covered call contract because you've got 100 shares, and you collect 1%, you can buy one extra share. And then next week, you'd have to do it again and do it again and do it again. And you'd have to do that for 100 weeks just to get your second 100 shares. And now you would get 1%, but on two contracts. So now after 100 weeks, you're buying 2 shares a week. So instead of it taking you 100 weeks to get to the next 100 shares, it only takes 50 weeks to get to the next 100 shares. And now you're buying 3 shares a week. And keep in mind, this is ignoring like your shares might get called away, the price of the stock might go down, might go up, might go down. This is just assuming, the price of the stock just stays the same forever, which we know isn't the case, but this is just hypothetical. You keep going. Now it only takes 34 weeks to get your additional 100 shares, and now you're buying 4 shares a week. I'm not going to go 100 lines of the spreadsheet, but just buying that one extra share a week, it would take you 11 years to get to critical mass. So that's taking the long road. But that's also assuming that you're only starting with 100 shares and you're never putting another single dime into it whatsoever. But once you get here, you're going to have 10,000 shares. And every week, you're not just going to be buying 1 share, 2 shares, 3 shares, 4 shares. You're going to be buying an extra 100 shares and selling an additional covered call every week. So if you're earning 1% a week, this 10,000 shares is the critical mass goal. If you're getting 2% a week, which we just saw you could get on strategy, that cuts this in half. You'd only need 5,000 shares. Now, granted, 5,000 shares of strategy at current prices is what, over $2 million? But the point is, if you talk to a dividend investor, they'll be hesitant to retire on $5 million, right? They're going to slave till they're 70 years old. Maybe they got 5 million cobbled together, and now they're going to put it all in a dividend portfolio, and then, I don't know, live the good life until they're 77 and keel over and fucking die. That's the fiat fantasy ending. That's the happy ending that you get in fiat world. But this becomes much more manageable for something on like a $10 stock. If you needed 10,000 shares or 5,000 shares of something that costs $10 a share, now suddenly only need 50 grand. Now that gets you to critical mass, but you're not necessarily going to be able to retire on $50,000 of mining stocks or something, right? But the point is that's going to get you to critical mass faster. And you can mix and match it. So let's just take a look. I pulled up Riot. For some reason, Riot's premiums are pretty legit right now. So selling a cash secured put would get you 2% for this Friday. If you already owned the shares, selling at the money would also get you 2%. You don't have to be that aggressive with it, right? You could go up to the 13 strike, get 1% returns for the week, and then you'd get a little bit more call away value, which my Excel spreadsheet does not take into account. If the price of the stock is actually going up and you've got some call away value built in, that spreadsheet doesn't take into account that if you bought shares at 12.18 and you sold them at 13, that's also like not quite a 10% profit, but that's another 5% that you made in potentially just 1 week. Those type of gains are not that frequent, right? I mean, this might happen a couple times a year. It's not going to happen every week. But the kind of the point of the exercise is that the upside literally just doesn't matter, because at 1% a week for 52 weeks, just 1 year, that's a 1.67x return. So 67% return. That's what exponential gets you. 1% a week without reaching critical mass gets you 52% for the year because it's linear. 1% a week, reinvesting all of the profits and getting extra 1% on top of your 1% every week gets you to 67%. If we keep that going for 5 years, 1% a week, 52 times 5, what is that? 260? $13x portfolio in 5 years. That's even if the price of the stock never goes up a single cent, as long as it just stays flat forever. That's not profiting anything, no built-in call away value. And it doesn't matter if your account is 10 grand, it's going to go up 13x if you've reached critical mass. If your account is 100 grand, if your account is $1 million, capturing 1% premiums every week and reinvesting the profits gets this type of return. Now, as Bitcoiners, we know that, so this number is times X, and X is whatever your portfolio size is. And if you're invested in Bitcoin or strategy, you know that X will sometimes be 2X and sometimes it'll be 0.5X. So if your overall portfolio size goes down in half, your 13X profits is going to get cut in half. That's just kind of the way it goes, right? 13 is the multiplier times whatever your account size is. So if you're invested in strategy and you were holding from 500 a share down to 250, your X got chopped in half, but your percent returns on X are still consistent. And that's why in this particular account, this was the 5K account challenge that I was trying to see what I could do with 5 grand. That's why over the past year, my 5 grand, well, I'd have to go back past a year. I think my 5 grand was down as low as 3, right? As soon as I started trading these mining stocks when Bitcoin was at all-time highs in March 2024. And within 30 to 60 days of the 5K account challenge, I had turned 5 grand into 3 because the overall value of the underlying stocks had dropped. The premiums that I was collecting, the percent premiums I was collecting during that period did not change at all. I mean, it might have fluctuated from 1%, 2%, 3%, whatever, but the percents didn't change. Now, 1% of 3 grand is going to be 60 or 40% less than 1% of 5 grand. So your overall profits are also going to be reduced when your overall account size collapses. But once you get to critical mass, the upside is great, but it no longer matters because you've already created a chain reaction that pretty much, cannot be stopped unless you, like I said, you just chose a stock that's a complete dog and goes to zero. As long as you're not that shitty of an investor that you can't find a stock that doesn't go to zero, this works. this can't help but work as long as you just don't pick a complete loser. You don't have to have picked Nvidia before it went up 10x. You don't have to you don't have to have figured out that Apple was going to be the next big thing before the iPhone came out. As long as you don't pick an absolute giant pile of steaming dog crap, this basically works out. So going back to strategy, you can almost get enough for a mining stock with just 100 shares. There's a couple of cheap ones, but $800 won't get you another contract in a miner unless you go something cheaper like a Wolf. Now you could go out to 45 days with that $800 that you collected, and you could sell the $8 strike. Oh God, why not sell call, sell put? You could go out and actually get 1% return on capital at the $8 strike in 45 days. I didn't realize that was going to be the case, but you can just barely squeeze that out. So it might take more than 100 shares to get here, depending on the other stock. But as long as the premium that you're collecting on your overall portfolio is enough to add an additional cash secured put or covered call on something every single week, and now you're collecting an additional premium on top of the additional covered call, you have reached critical mass. So if Riot is going to be your secondary stock, you'd have to be collecting $1,200 a week in order to be able to sell an aggressive at the money cash secured put. Oh, sorry, that's the 45 days. 1 week out. And then you'd actually get another 2% return on your collateral based on the additional cash secured put that you sold. So you can't quite get it in 1 week with strategy, but if you sell 45 days out, you can easily get that $1,200 out at the 525, which is the 25 delta. Not the safest strike in the world, right? This is definitely could be threatened, but you can bank this $1,200 profit and immediately sell a $12 strike in a mining stock or your other favorite Bitcoin treasury company. I dipped my toe into Strive after Jeff got announced. So in this case, fortunately, they don't have weeklies, so I'd have to go out to a month. But in this case, I'd only need $500. So if I sell one cash secured put, one covered call, 45 days out, 525 strike, collect $1,200, I could actually sell 2 cash secured puts in Strive, 31 days out, collect another $100 each, and turn linear returns into compound interest returns. I was reminded of this when Hermes was posting about his strategy today, and people were still kind of like, there's some Misty holders that refuse to accept that Misty underperforms. It doesn't just underperform selling your own covered calls. As far as I can tell, it actually underperforms just holding spot MSTR. Like if you had 1,000 shares of strategy, you'd probably end up being able to stretch that money out longer if you just lived off the shares. Like every month that you needed to pay your mortgage, if you just peeled off whatever 4, 5, 6 shares, you'd end up with more money at the end of the day, at the end of the month, at the end of the year, at the end of the 10 years than putting that money into Misty. The only thing that Misty gives a person, as far as I can tell, is convenience. And you're going to pay for that convenience, via underperformance. And that's perfectly fine. Like, I'm okay with people investing in Misty if they understand that. And if you even listen to Jay, who manages the fund, if you listen to him talk, they even admit that the fund is designed to underperform. It has to. It's supposed to generate income, but it doesn't necessarily generate income and overperform just holding the underlying. They've got a company to run. They're peeling 1%, fees off the top, I believe. I believe it's a 1% management fee. So it's a no-lose scenario for them because they're just collecting the fees off of the assets under management, if I understand that correctly. And for people who want the convenience, right? Like if putting it in Misty gives you your budget and you're like, okay, whatever Misty's dividend is, that's my spending money. If you need someone else to set your limits and your discipline and your budget, and you're willing to pay for that convenience, I'm totally fine with Misty investors doing that. But some of them feel like they have to create this fantasy narrative that they're getting this convenience and also outperforming like other covered call sellers or people just holding MSTR, just the common shares. Misty has a chance to outperform. Like if they traded, perfectly, there is a scenario where they could outperform just holding spot. But as far as I can tell, they've never done it. That being said, holding 100% in Misty would probably outperform the S&P 500, probably, because strategy is its underlying position. And you'd have to fumble the bag so hard with strategy as your underlying asset. Like you'd have to mismanage that fund so badly to underperform the S&P 500. Like Misty might even outperform Bitcoin because strategy is leveraged Bitcoin. And as long as, Misty doesn't mismanage it so poorly that they undo all of the leverage that strategy provides, then Misty might even outperform Bitcoin. But I haven't looked at that. That's just me ruminating, I suppose. So in order to reach critical mass, you don't necessarily have to own, if you're getting 1%, you don't have to own 10,000 shares. Or if you're getting 0.5%, you'd have to own 20,000 shares. It's just whatever that ratio is that allows you to buy another 100 shares. And some of the TradFi covered call sellers think that talking about 1% returns a week is a little pie in the sky. But a lot of them are just simply not orange pilled, and they don't understand that Bitcoin's volatility is not going away this decade. In 50 years, will I be able to continue to implement this strategy? Maybe not. But I'll probably be dead, so it kind of won't matter. I'm going to try to live to 100, but so 50 years I might be still kicking. But 60 or 70 more years, it's probably someone else is going to have to take the watch. What else did I want to look at? I mean, I wouldn't go too much cheaper than $10 a share on your secondary position, because it's just very hard to squeeze out premiums, right? Something like a Wolf, I was trading before, and it was like $6 a share, maybe $5, $6 a share, and you can get a little bit of premiums out of here. But imagine when the stock price drops to $3 a share and you're trying to get 1% of $3, right? You're trying to collect $3 in premium, and the bid ask spread is already a penny. Like it's brutal. So be careful with the size of the stock. I think $10 a share is a nice kind of sweet spot. If a $10 stock drops by 30%, you're still at 7. But if a $5 stock drops by 30%, now you're at like 350. That's kind of a pain in the ass. I mean, you still have the option to roll out, longer on some of these smaller stocks. But just be careful, right? Not financial advice, but You don't have to be irresponsibly long all the time. CLSK is one of the other ones that has good liquidity that I have been running the wheel on. Price is very similar. $23, 2% returns for a week. All right. I think that was it. And the point of this is kind of like once your account becomes too big to fail, the underlying asset can crash 50%, 75%. And if its original value has reached a certain level to where it can support your lifestyle, even after a 50% drop, this is what has given me the confidence to quit my job in December. This is the type of math that I did. This is the simulation, that I kind of went through. And it's only been 8 months, but so far so good. I've been running this strategy since May of 2020, and my Robinhood account history is going to look kind of funny because I've actually taken out more money than I put in, which is a good thing. But so it looks like I had negative $42,000 in September of 2023 when my account was at its lowest. But that's just because I've made more money in this account than I put in. So when you take that money out, Robinhood, I don't know, doesn't know how to calculate it in a weird way. So it actually looks like you had negative money at some point in the past, which is impossible. So, but yeah, this account has had some ups and downs, but the strategy has continued to work for the past 5 years. Chris Cole did some research. I think his company's called Artemis, and he put this portfolio together called the Dragon Portfolio. I want to study it more, but he claims that his portfolio, back tested over 100 years, would have survived all of the crashes and this, that, and the other thing. So I think he's got some long vol in it, some short vol. I think he's probably figured out Bitcoin since the video that I saw him in, but his original Dragon portfolio had like 40% gold in it or something. So it's definitely a little prehistoric in that it's pre-Bitcoin. But I think you could probably take that Dragon portfolio and just swap Bitcoin in for gold and bonds, really. So you might end up with like more like a 60-40, because if gold was 40% and bonds was 20, that gets you to 60. If you swap Bitcoin in for gold and bonds, the other 40% would probably be like some combination of long and short volatility stock positions. That's just a guess. I forget the different sections that he had in there. But he did specifically cite this covered call strategy that I've been using. And there were, decades at a time where this particular strategy outperformed the market. But then during periods of extreme volatility, which makes the premiums go up, but let's just look at S&P 500, right? Where's COVID? Is this the 2020? I got to go back farther. So this is the COVID crash, right? If you were selling covered calls when it crashed from 320 to 257, okay, you made a little bit of money that month. But because the V-shaped recovery was so vertical that if you were selling covered calls at like the 265 when the price was 257, you probably missed out on the recovery to 290, to 300, to 334. So selling covered calls at the bottoms of these crashes is when covered call selling loses a lot of its money. So if you can either just manage to avoid selling at the bottom, selling covered calls at the bottom and waiting for the recovery, that would help out your performance. Or like I said, if you've already reached critical mass, it kind of doesn't matter if you miss out on some of this upside if the premiums that you're collecting are enough that you're able to pay all of the bills, right? In that sense, I guess I'm making a case for Misty in that if you don't mind underperforming, and if your account size has reached a size that underperforming no longer matters, then have at it, right? If you don't like selling covered calls, if you don't like the headache, yeah, it's fine to outsource that to someone else. But don't just try to say that you're going to pay for the convenience and outperform. That's not going to happen. All right. That was a pretty long rant. So let's check the comments and see if there's anything worth talking about. What's up, Howard? Been weighed down with critical mass for some time now. You can have some if you want. You know what? And I think that's that. I know you're being funny, but I think that's kind of like circle of life type of thing. And it's a little bit of a the way that I feel about Bitcoin as well. I like the circular economy aspect of it. I don't like there's very few things that I've listened to Sailor say that I disagreed with. I credit him for like giving me the final nail in the coffin of my orange pilling. Like 25 hours of What Is Money on Robert Breedlove's podcast pretty much did it for me. I was I don't know, I guess I was a crypto anarchist for a while. So I liked the idea of freedom money, but I was happy to trade shit coins and all of that, stuff for years. And so I have to credit Sailor for like giving me my full on laser eye surgery. But I don't like the never sell your Bitcoin mantra. I think it's fine for him and as a company to tell the investors that that's their intention. But I don't think it's necessarily good for mankind for every single person to treat their Bitcoin stack in that way. I think once people, have made their money and they're riding off into the sunset, I think it's your job to make that Bitcoin available for the 18-year-olds of the world. If they make something of themselves and they can come up with something that provides value to the world, I think it's philosophically consistent to peel off a few sats and pay them. This whole thing about, stacking fiat so that you can buy Bitcoin, I think that only works for the next, I don't know how many decades. I hope to live long enough to see the world where hyper Bitcoinization is achieved. And I hope that fiat goes out with a whimper and not a bang, right? I hope we don't need World War frickin' 3 for the Great Reset to finally bury fiat for good. I hope it's just kind of like someday everybody wakes up and doesn't remember when fiat died. It's just kind of like, how many sats is a stick of bubble gum at the 7-Eleven? I kind of hope that's the way that things go. If it does, then Satoshi will go down in history as the greatest human to ever live. Fiat, debasement, and war and criminality has been a plague on humankind since the beginning. And if solving the Byzantine generals problem solved that, there's no greater gift to humanity that I can think of. So that'll be cool. But yeah, I think once people who have reached critical mass, I think them being willing to sacrifice some upside is kind of like a gift to people who are willing to take a chance, right? Because that upside goes somewhere to somebody. What's up, Hash? Let's see, bought Ulti this morning. If you need need someone to yell at, what the hell is Ulti? Is that the combo where it's got all of the covered call strategies in it? Yeah, portfolio of covered calls. So that's like all of their shit, right? With their top holdings. Okay, Hood, Upstart, Ion. I'm surprised Strategy is not in here. So whether they're just selling covered calls on a basket. Probably. What's up, Kanal? Peter, always a pleasure hearing your insights. Thank you very much. What's up, Strategy Dude? Trevor, nice. This is kind of compounding is what I'm trying to do in my IRA, but you explained it so much better. Glad to see my thoughts are on track. Yeah, exactly. That is the point. And I've been trading against MSTY and IMST, and I went ahead and put them in my IRA so that the drip could just compound tax-free. Now, of course, in my traditional regular accounts, I'm still paying taxes and all of that crap. So that has to be a factor too, right? Yeah, the taxes. I wanted to convince my wife to move to Puerto Rico so we could get that low capital gains rate, but she didn't bite, which is kind of really sad because she's Puerto Rican, but she can't she wasn't born there, and she can't stand the idea of being stuck on an island if the shit hits the fan. It's like, how do we jump in the car and evacuate if we're on a fucking island? So I get that. All right, so that was a lot. After all that being said, I guess I'll check the accounts. Strategy is still up, so I'm assuming there's not going to be any positions that I need to roll. I generally only roll early when strategies goes down, because then the premiums ain't worth a shit, and I need to roll down to make the premiums meaningful. Now that kind of puts me at risk for what I was talking about, was when the stock price goes down, you risk getting whipsawed. All right. So as the price is going down, I'm basically rolling my strikes down, 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 and then I end up missing out on some upside here. But as I've been explaining for the last frickin' hour, once your account reaches a certain size, it no longer is meaningful, right? It's pretty meaningful if you just have 100 precious shares of strategy, and they get called away at 425 and the price runs to 450. That's going to be heartbreaking. But at some point, it just no longer matters. With that being said, I'm so bullish on strategy over the next 6 months that I am still stacking long calls, right? So I am not limiting my upside. I like the way that strategy gives you some data points. You can see that my overall net delta here is 1,500 shares, right? So I have 1,500 shares. I've got 1,000, a little over 1,100 delta is short. So these are the covered call positions. This is my upside that I'm limiting. However, I've also got long calls that add up to another 1,000 delta. So even if I get wrecked, as I am getting wrecked on these 430 strikes, that's limiting about 1,000 of my overall delta of price exposure. And so if I didn't have any of these covered call positions on, my overall delta exposure in this account would be about 2,600-ish. So I'm limiting about 40%. Yeah. I have covered calls limiting about 40% of this account over the next 30 days. I had positive theta yesterday, but with strategy's price coming down, that's reducing the amount of premium that I'm collecting on the short calls. So your net theta will fluctuate over time based on the extrinsic value in your short calls. It's also going to fluctuate based on the days to expiration on your long calls. These 1080s, because they're farther out of the money, are going to have higher theta. So they're cheaper. I can get more delta for a lower price, which is why I buy them. But they also depreciate much faster. So the 1080s are going to depreciate much faster than the 530s relative to their value. So keep that in mind. So if you look at theta on the 530s for December, it might say, let's just look at them. Instead of me saying what they might say. $10.80s. So theta on the 1080s is 12, right? So this is losing, its value is 810. And as of today, and keep in mind, theta is going to fluctuate as well. But as of today, this $800 will go down $12 by tomorrow. And let's look at the 530s. The 530s are going to go down $24 by tomorrow. Now, looking at that, you're going to be like, well, I thought you said that theta was higher for the 1080s than the 530s. Theta should be a smaller number. But you have to look at it as in proportion to the value of the option itself. So $12 divided by the 1080s value of 810 is 1.4% of its value decaying every single day. Whereas, what did I say this one was? The 530s is 24, maybe it's closer to 25. So 25 divided by its value, which is 4,800. Divided by 4,800. So it's only going down 0.5% every single day. The total amount is higher, but it's a much smaller fraction of the option contract's total value. So don't be confused when somebody says, okay, theta is higher on short dated expirations or theta is higher on 1080s. The number may may not look that way, but it has to be compared relative to the option's value. Because the 530s are so expensive, 6 times 8 is 48. So the 530s are 6 times as expensive as the 1080s, but theta is only twice as high. So relative to its price, the 530s ice cube is melting slower than the 1080s ice cube. Yeah, so all of that to say that that this is basically a theta neutral account. Some people try to make sure that they're delta neutral, gamma neutral. There's all of these different strategies, and apparently I wasn't intending to do this, but if theta was exactly 0, this would be a theta neutral, right? There would be the exact amount of money draining into this account and then out of it, which would necessarily result in a positive delta, right? That would definitely be room for some upside in an account like this. And in this particular account, that's this top value up here, is the net delta of 1,500 shares. But yeah, just quickly looking at these, there's tons of extrinsic value left in these accounts or in these contracts. I probably won't roll them before earnings anyway. So nothing to really do there. Tesla's coming back to life, and that was one thing that I thought about doing yesterday. I was like, you know what? Should I just take 10% of profits off the top, off of my my long calls, and just slam it into Tesla while Tesla's still cheap? But I kind of can't bring myself to do it before strategy pumps. Like, I want to see it at least like 50% from where it's at now. I'd really like to see it pump quickly to 1,000, but I don't know if we're going to get that before the summer is up. We might have to wait till the fall to get that final leg up. I would love for there to be just some kind of massive earnings call reaction to the change in EPS. That would be freaking fantabulous. But I'm not counting on it. We could instead just see like a slow grind, right? The market loves to just do what you don't think it's going to do, because I was trying to, I started building this pattern because before March of last year, it looks like, strategy was at 50 and then it went to 200. So it did a 4X in about 5 weeks. Then it did a 50% correction. And then boom, it was like 115, went to 500, did basically a 4X in 8 weeks. And then did a 50% correction. So I was like, oh, okay, I'm seeing a pattern here. 4X, down 50%. 4X, down 50%. So does that mean that the next leg up is going to be 4X from 250 and we're going to see 1,000? That would, the pattern would repeat. But in November, strategy was like leveraged pretty highly. So that may have contributed to this blow off top. So strategy is kind of under leveraged right now. They hit the commons so hard that their leverage ratio is kind of down in the dumps, and the preferreds is going to, I don't know, fix the glitch in a way as far as the leverage ratio, but it's not going to happen overnight. So I don't know if we're going to get another one of these face melting rallies. We might just get some kind of like slow grind up to whatever the hell it is, and maybe there's going to be less volatility with strategy. If we get some face melting rally in Bitcoin, I think strategy goes with it. There's like no question. So if If Bitcoin does one of these numbers and goes up 50%, then yeah, strategy goes up probably double. I think that's pretty reasonable within within 2 standard deviation. So I would say anywhere from, if Bitcoin goes to 150, then I'm just guessing, and I don't do price targets or valuation models like official shit like Jeff does. But I mean, just ballparking it, right? If Bitcoin goes to 150, I mean, strategy goes what, somewhere between 800 and 1200. I think that's pretty reasonable. But if Bitcoin just grinds up, then there's going to be front running for strategy on the S&P 500. But then do we get crashes like every time the committee doesn't let them in? Do we get some kind of temporary repricing? I don't know. And that's why I don't try to predict it. And that's why my account has longs and shorts, longs and shorts, longs and shorts. All my short positions are under 45 days, and all my long positions are over 90. And that's just kind of how I avoid shitty theta positions, and I short the shitty theta positions. All right, so this is the spending account. Net theta is negative here, so I'm losing more money every day than I'm gaining if strategy's price stays the same. But since this is kind of like my my discretionary fund, I don't mind having the most risk in this account. This is the challenge account that I'm trading against MSTY and IMST. My 440 strikes are slightly underwater, so nothing to do but sit and wait here. My 1080s are slightly in profit, so between these and the poor man's covered calls, these positions will be used to pay if I have to roll these for a debit. That would be how I would avoid having shares called away. Now, the other thing that MSTY has gone over when I've seen Jay getting interviewed, so I have a poor man's covered call created here at the 200 strike. They would not have their synthetics set at 200. Generally, they're close to the current share price, and they'll roll it up or down accordingly. But let's just say, for instance, they did have a synthetic at 200. If strategy rolls, goes up to 550, 650, they would roll their synthetics up and capture the profits from rolling up. And I could do the same thing with this poor man's covered call. Poor man's covered calls are not true synthetics. So I guess they'd be like synthetics of synthetics, because I don't sell the cash secured put. That would make this a true synthetic, which would make it much more expensive, which is why I don't do it. But if strategy runs up to 550 a share, 650 a share, whatever, and these covered calls actually got completely wrecked, I can either just sell these completely, or if I wanted to continue the poor man's covered call because I'm still bullish, I could just roll this 200 strike. That's currently 93 delta. I could roll it up to, whatever, the 300 strike. Well, by the time strategy got to 650, I could probably roll this to 400 and capture, I don't know, capture whatever. So yeah, so I can either liquidate these positions to pay for the rolls completely, or potentially just roll up the strikes of my leaps and capture the difference. That would also be an option. What's up, Angry Buddha? With Alti, they focus on the stocks with the largest premiums. It's much more actively managed. Okay. You'll have enough extra money to deal with island life if shit hits the fan. Hell yeah. Compound lest you get pounded. I'll put that on my tombstone. All right, yeah, so nothing to do here. Let's check the 5K account. Can't imagine there's anything to do here either. I rolled up my CLSK cash secured puts to 1250. These might actually be even underwater. What's CLSK trading at? 12? Yeah, so I might get assigned the CLSK puts this week if the price holds steady. Got another one on Riot. Yeah, there's nothing to do here. I already dealt with my poor man's covered call. I think this was expiring in October, and I was able to roll the 250 strike up to 300, and that gave me an extra like 5 months on the long call. So instead of just booking that, whatever, $3,000 in profit and exiting the position entirely, I gave myself an extra 2.5, 3 months to sell more covered calls. So as long as strategy doesn't shit the bed in the next 5 months, I should be able to book some more profits in that position. I think that's about it. Did this one a little bit later today because Adrian was live streaming with Smarter Web Company, so check that out if you get a chance. Finally finished running his mouth, and I was able to go live. So support him in that endeavor. I will probably do a True North now on Saturday. I'll cover winter and MSTY. Jeff mentioned on the show a couple of weeks ago that he saw people posting about like a 60-40 Misty winter portfolio. And so I'm going to do a little bit of a deep dive on winter's positions. They're almost exact opposites of the Misty position. So I guess people decided, oh, well, I'll just take the 60-40 and I'll be 60% upside with strategy and covered call selling for Misty. And then I'll be 40% winter. And if the price of strategy goes up, then Misty will print. And if the price of strategy goes down, then winter will print. And they'll create some kind of stable income generating thing. So I've been doing a deep dive on that. Probably will do that on Saturday. So be looking forward to some of those announcements. All right. Appreciate everybody for tuning in. Be good, y'all.